How much maintenance or capital expenditures do I set aside for co-living rentals? This is a great question. And let me just highlight what this even means. So typically what you do is you take your long-term rental income, like when you're analyzing a deal, the worst way to analyze a deal is say, my rental income is $2,000. My mortgage is $1,900. I'm making $100 a month. That's not at all high. That's like the worst way to analyze a deal. Well, how you actually analyze a deal is your cash flow, your monthly profit is your income minus your expenses, which includes your mortgage, any utilities you're covering, insurance, taxes, all that stuff, if it's lumped into your mortgage or not. And then you have to subtract away some reserves and property management. Typically, property management on a long-term rental is 10% of the income is property management. Then you have maintenance and capital expenditures, where maintenance is like you got to send a plumber out because there's a clog in the sink, or there's a little lighting issue that you need to, like, that's your maintenance, right? You're setting aside 5% of your income for that, and then 5% for capital expenditures, which are reserves for your property. That is, you're going to need to replace your roof over a set period of time, right? The newer the roof, the later you'll have to replace it, but you still have to replace that. You have to replace your flooring. You have to paint the full house. You have to replace appliances. These are your capital expenditures. You're setting aside money for when those things come up. And then last is vacancy, right? We talked about that in the last one, but you typically set aside around 8% of your income as vacancy, which means around 1 month of the year, the property is vacant. Depending on the management strategy, short-term, mid-term, long-term, co-living in the market, all these things, your vacancy is going to be a different percentage, but that's the rule of thumb. 10% property management, 10% maintenance and CapEx, and 8% is vacancy. And those percentages are of the income that you generate. Well, if you have a long-term rental generating, let's go into the maintenance and CapEx, right? So if you have a long-term rental that's generating $2,000 a month of income, 10% of that for maintenance and CapEx is $200 a month. Well, if you have a co-living rental that's generating $6,000 a month as rent by the room, you're setting aside 10% of that. That is $600 a month. That is pretty excessive for how much you would anticipate to spend in maintenance and capital expenditures. First and foremost, let's split the 5% for maintenance, 5% for capital expenditures, right? So if you're saving $200 as a long-term rental, but in theory, you'd be saving $600 for a co-living, it doesn't work that way. Just because you have co-living and rent by the room does not mean your roof needs to be replaced any faster. Does not mean you might have to paint your property a little bit more because the furniture is already there. You don't have to worry as much about the biggest paint issues and all that I deal with. People moving their furniture in and out, they're destroying flooring, scratching things, they have pets, they're smoking, like things like that. Those are much more common in long-term rentals, much less common in a co-living rental, right? So like the painting things, the replacing the flooring, maybe the appliances will get a little bit more wear and tear because there's more people. But typically my co-living tenants are not sitting there cooking up nearly as much as my long-term tenants who are probably cooking mostly every day. Like they're cooking every day or multiple times a week. Yes, you might have some co-living tenants that do that. More often than not, a lot of our tenants are saving money on housing to then be able to go eat out more. So what I mean to say is if you are saving, let's say $100, 5% of the $2,000 for CapEx, you pretty much only need $100 for the CapEx for your co-living rental. So let's give it a little bit buffer, right? If you are saving 10% of your long-term rental income for maintenance and CapEx, that is $200 a month for maintenance and CapEx. If you are saving 10% of your co-living rental income, $6,000, that is $600 a month. I don't think it's appropriate to save only $200 a month, right? The same as your long-term rental, but I definitely think saving $600 a month is way excessive. The answer is typically somewhere in between, and kind of the rule of thumb that I've gotten to is around 15% of your long-term rental income is what you should be saving for reserves for your co-living. So for that example, if you have $2,000 a month long-term rental, instead of saving 10% or 200, you save 15% or 300. Right? It's not as excessive as the 600, but it is 15% of your long-term rental income. And that really accounts for the additional maintenance, which you will anticipate there'll be more maintenance. More people using the bathrooms means more potential clog issues and plumbing issues, more light bulbs being burnt out, little things going wrong that you're gonna have to send more maintenance. So that extra $100 a month is basically accounting for those extra maintenance issues because the capital expenditures are roughly the same, right? So that's basically where I add that extra 5% is really to the maintenance. That's kind of where I would keep it at. Really, based on the long-term rental is kind of what I do. If you feel like you want to have more reserves, you're more than welcome to. I'm not the end all be all for this stuff. I'm just sharing you transparently what I do. What I used to do is 10% of the maintenance and CapEx for my co-living is what I would save 10% of the co-living rental income. But looking back at my profit and loss statements, my actual expenses, my maintenance does not go up substantially. So it's not that I need to now save, in that instance, 3 times as much in maintenance and capex, it's just not necessary. It's not needed. And if you are underwriting that way, you're kind of setting yourself up. What's good is you're under promising and over delivering. You're thinking it's going to be worse than it is, and you're getting more returns than you anticipated. That's also doing is it's preventing you from buying more deals that would work because you're being overly conservative. This is my risk tolerance. Everyone else has their own risk tolerance. Do you want to save 20%? So instead of $200, you save $400. You're more than welcome to do that of your long-term rental income. If you want to save 10% of your $600, right, you're more than welcome to do that. Or another rule of thumb, right, either 15% of your long-term rental or 5% of your co-living income. That roughly translates to the same. In this exact example, it's the same amount, $300. That's just a coincidence. Like it's not always going to be 15% of long-term rental income for maintenance and capex. It's not always the same as 5% of your co-living rental income, just because it's a 3 times difference. I don't want to get too much in the weeds of that. That is why it's the same in this instance. But those are 2 great rules of thumb. Instead of saving 10% of your co-living income for maintenance and capex, you can set aside 5%. Or if you want to base it off your long-term rental income, you can set aside 15%. These are not hard and fast rules. These are not guaranteed. These are just you setting aside money for your properties. Another big thing to account for, at least the way that I educate my super investors, even for free on Wealth to Real Estate, I educate everyone this way, is when you're going into an investment, especially when you're raising money from someone else, right? It's someone else's money in the deal. I would rather over raise the money. I'd rather set aside reserves. I'd rather raise $10,000 or several months of reserves for that property in advance, because if and when something goes wrong, I want to make sure I have the reserves. I'm not building that money up each and every month. Like if you're setting aside $300 a month and by month 3 you have $900, but you have a $2,000 expense, well, you don't have enough money for that. So that's why I recommend setting aside several months of reserves up front, or like a dollar amount as well. Like fill up your reserves, 10,000, 15,000, 20,000, depending on the property size. You can go as low as 5,000, whatever. You can do a year's worth of reserves, 2 years worth of reserves, whatever you want to do that makes you feel comfortable. For me, I have various income streams. I can always float whatever comes up when it's like simple things on a property. But what I would recommend is you set aside those reserves just like I do. I raise those reserves in advance because if something goes wrong, I want to make sure I have the money available, because by the time it takes 3, 6, 12 months, you may not have enough in there for those expenses. It's better to raise that in advance. So as opposed to by month 3 having 900 when I would need 2,000, well, I already had $10,000. We're dipping into that $10,000 and we're still continuing to build the reserves. Now we have 10,900 and we spend 2,000. Okay, we have 8,900. We just keep adding $300 a month to that to build the reserves. Then I set a cap to that. Typically, depending on the property, $15,000, $20,000, $25,000 cap to say, okay, once we have $20,000, $25,000 in reserves, we don't need to keep setting aside reserves. That's more than enough for us to deal with the majority of issues that will come up on any given property, especially a co-living rental. And if that's not the case, well, cool. We have to put in the extra money. We're making more returns in advance. So to simply wrap this up, how much maintenance and capital expenditures do I set aside for co-living rentals? 2 rules of thumb. If you're basing it off long-term rentals, I would do 15%, 15, 20%, right? It's up to you on your risk tolerance, 15 to 20% of your long-term rental income, or I would set aside 5 to 10%, really pushing it at the 10%, but 5 to 10% of your co-living rental income, right? And just to give simple numbers again, if it's $2,000 a month of long-term rental income, 10% is $200. If you're doing the 15 to 20%, that's $300 or $400 a month that you're setting aside for maintenance and capital expenditures. If you're doing $6,000 a month of co-living rental income, 5% is $300, 10% is $600. I think somewhere between your 10% long-term rental income and your 10% co-living income is the right amount. And honestly, somewhere in the middle is much more accurate. And I just gave you 2 rules of thumb that kind of get you those numbers. At the end of the day, understand that if something goes wrong with your property, you better have the money set aside between you and your partners. I don't like to teach people who don't already have some stability and some financial resources available to raise money, because it's not like fun money. It's not free money. It's not monopoly. There's no like asking. I mean, unless you have assets or money set aside or your capital partners will float it, like you don't want to put yourself in a position in which you cannot float any big expenses that come up for a property. Rarely is it that you're paying $50,000, $100,000, $200,000 up like in a go, but you'll need to put in a few $1,000s, $5,000 potentially, depending on the repairs that you need on the property. So if you are raising money, make sure to raise reserves as well, so that if you are in a bind, you have that money up front. Hopefully that answers the question. And the more money that you raise up front for reserves, the less you need to keep track of monthly. So if I'm raising $10,000, $15,000, $20,000, I would stick with the $200 a month because I already have a bunch of reserves set aside right there. That is a pretty solid example. If you want more of that on my analysis, once again, free Wealth the Real Estate School community. I literally go into a lot of these topics. And if you are someone who is already a real estate investor who wants to level up leveraging, either creative financing, buying deals from wholesalers, raising money, whether, for long-term rentals, not just fix and flip. That's easy. Raising money for longer term rentals, co-living and all that. Or you need to specialize in your co-living rental strategy. You need better systems, tools, accountability. That is super investors. If that is something that sounds like the right fit for you, reach out to me. I'm happy to see if you're a great fit. If you're not, I would recommend that you just join Wealth to Real Estate. Free community, tons of value to you. But if you're ready to take it to the next level, that's really what super investors is for.